Hey Anurag, thanks for agreeing to do this. I think we've been wanting to have this conversation for a while. Very excited to speak to you.
Same here. As said, I've been listening and watching you guys grow over the years. It's a pleasure, honor to be here talking to you. Look forward to this conversation.
Thank you. I think retention is a very important metric for us and for you. So it's good to know retention is strong. I think that's what makes all of us pretty happy. So Anurag, you're Pune based,
Yes.
and a bit of a rarity because I'm in Pune as well. You're in Pune too. Very few large startups are there in Pune, but what I've noticed is that any folks who start in Pune, they're quite resilient as well as wanting to build a big outcome. So maybe the number is less, but there are quite some scaled startups now like Elastic Run, First Cry, Express Bees, you guys. So why Pune?
Yeah, thank you, Aviral. So it's a very interesting one because I get asked this many times. So our thought process was actually very simple, not a complicated one. We were starting a fintech, and in our business, you have to go to Mumbai for all the partnerships, be it banks, bureaus, regulator, payment networks, and all that. So we just thought it was easier for us to drive down rather than fly. That was our initial reason. But a lot of people, of course, like wanted us to be in Bangalore initially, or I assumed that we are in Bangalore actually, because you're building a tech company. Um, but I think Pune gave us also that kind of cover that we worked at our own pace. We were not too much guided by what's happening in the market, so gave us a lot of latitude in terms of that. uh, and I kind of that suited us with our kind of philosophy. We were very product focused tech company, so we work with our pace, whatever we wanted to build. Third thing is, in a way, it was give us a lot of time for us to build rather than get compared and get guided by what the rest of the people are doing. Third thing is, like to a surprise, we saw a fairly low attrition rate in Pune over last 3 years, which worked out a very very strong benefit in our favor. And I think I don't know whether it was our ability to work with the team together around the same problem which we were solving, but the outcome was that we kind of stuck together fairly good. Especially the like the first 50 people are like completely stuck together. So I think this worked out quite well for us. And now, as you rightly said, the ecosystem is building up. We have lots of large companies out of Pune in the tech area, especially in the SaaS side.
Right.
And consumer side also. As I say, First Cry is the largest brand from here. But I'll tell you, there is another tangent reason for that. For us is that, like in banking, when I came to Pune from my previous startup for the first time, and I had heard about Bajaj Finance, but when I realized the magnitude at which they had built, and this company got built under the nose of banks in Mumbai, we never got to know about this till it actually became such a large company in consumer finance. So that's also like a tangent, like a distant inspiration for us. Like you can stay out of the limelight and build a large company would make sense for customers. And this was completely built over last 10-12 years in Pune right here, which almost every bank in Mumbai now learns from, or rather tracks them, and how are they doing it at that scale. So I think this is I would say a distant inspiration for us also, that can we build something like that sitting out of Pune. So these are few reasons for us.
No, that the Bajaj reason is quite interesting. I actually didn't think of that. I think also Pune tends to people are like put their heads down and build. I think in Bangalore, when you have so many things happening around you, there's a there's a very strong reason to get distracted sometimes and also to move around companies. So I think it's a good way to keep people together, keep them committed, and I think great city, great infra have grown up here, and I hope you become the Bajaj of the fintech world, and there are a lot more fintechs that are built around, inspired by you.
Yeah.
And so, you've had a long career in finance. You took the engineering MBA route, which I think has become increasingly common, but would love to learn more about what was the decision making there, engineering, then you did an MBA, then you had a long career in banking, and then you decided to start up. So if you can talk us through that
Awesome.
decision.
So come from a middle class family, figured out, like engineering was the best thing to do that time, way back in 94, 95. So did my engineering and then joined HCL Tech, as my first company. Frankly speaking, couldn't understand the impact tech can create in one's life, and that's why uh, I happened to work on Indian businesses actually. The most of this application services business was working for US clients, but HCL had a software technology park license, and I was part of the team. So I worked for Indian clients, so could understand what's happening in the rest of the world that time. So I thought probably MBA will give me a better, shape in my thoughts, what I want to do in life. So that's how I went to do my MBA and happened to be in ICICI Bank as management trainee way back in 2003. Now, many of you would not know what ICICI Bank was that time, what it is today. Most of the ICICI was largely wholesale company, wholesale finance company. It was moving to become a universal bank as it is called today. In fact, the bank was set up separately in 94, and 2002 is the time when the reverse merger happened and they started operating as a single company. We were the first batch of management trainee who joined ICICI, and I happened to be in retail banking, which is primarily doing banking for people like you and me, individuals. Now, this was completely new for me because, as you know, most of in IIMs you study corporate finance like everyone else. I also did that. In fact, I wrote a paper in my MBA days on option market efficiency. So when we landed there in retail banking, we were like completely surprised that why are we being, I had never heard things like delinquency or TAT, turnaround time. None of these words were ever known. And but Mr. Kamath took a session for us and say that this is the future of Indian banking. Our 80% balance sheet is wholesale, and we want 80% of our balance sheet to be retail. So you guys are lucky to be part of the team which is going to build that.
That's a big transformation.
Yeah. So we were, we still resisted that, by the way. So then, most of the companies, management trainees are usually pampered for the first 1 year. So we were told, and if you don't like, then you can go back to corporate banking or structured finance or treasury. These were the typical roles which most of the IIM grads joined in banks those days. And rest is history. We were like super lucky to be part of the growth cycle. 2002 to 2006 was a massive growth cycle for India, especially for banking and retail banking and for ICICI. So we were like at the tip of the, growth cycle, saw a massive growth. And then came 2008, which affected everyone, but affected ICICI the most because ICICI had a large market share in unsecured lending, which was built over the last 6-7 years. I actually had moved out of retail banking to corporate banking, after 3 years. I was part of the investment banking team, but I moved back to run actually collection strategy in 2009, the peak of the period. So got to learn a lot of lessons, firsthand. And then post 2010, as the storm was over and the bank was restarting to build the consumer banking business, I moved back to consumer banking and restarted, credit cards and PL business. I was part of the team. And since payments happened to be my, one of the deliverables, so I was heading strategy for payments for the bank. I was lucky to be watching very closely the emergence of fintechs. Now, I'll just tell you about, so technology in banking, as you know, has been there for many years. But if you talk about Indian banking, there were distinctly three eras. The first era was like, I would say, late 90s, early 2000, which was the era of putting up core banking systems, which is, like automating the backends, and regulator drove hard. Both private sector banks and public sector. Private sector banks mostly started with new tech, but public sector banks automated that. The second era came in, like, I would say, mid 2000s to like early 2010, 12, which is where a lot of work happened on, what you call is automation. So automation was the buzzword, where you are automating processes. This is about middlewares of the banking. But post 2010, this front end innovation happened. Now, of course, most of the banks launched apps, digital bank, and their internet banking websites and things like that, which is where things became a little different, because this was a very iterative process. You don't get it right on day one. You iterate. You don't change core banking that much. You don't change middleware that much, and that's why banks don't build tech, they buy tech. So it was much, like most of the technology in both middle side came from system integrators, people like IBM's, HPs of the world, brought a lot of innovations from, I would say, smaller companies, integrated them. The first was done by people like Infosys, TCS, who built core banking systems. But this was new. And since I was part of the payments, and as you would recall, that was the first area where fintech started, where companies like Paytm, MobiKwik got formed. We were the bankers to them. Since I was head of payment strategy, I got a chance to work with them very early. So I could relate to that the future of consumer interfaces in financial services will be probably built and dominated by tech companies who can build tech. So that
back in 2010, I actually, now that you say it, I realize Paytm is that old, but everyone thinks fintech started in 17. Clearly, it's much older than that.
So you will be surprised. By 2012, in fact, Paytm was already a fairly large brand. MobiKwik had already there. Payment gateways, like Citrus came in 2012. Jitin started then. So a lot of this work, which was like hardcore banking, ICICI sold off their payment gateway business to First Data in 2010. And that was one of the first big tech, even Payback. So ICICI sold Payback, which was our rewards pro company. We hived off in 2010. I keep saying we means I basically meant ICICI Bank, because I stayed so long that I still empathize with them very much. Yeah. So I think by 2013-14, it was quite obvious that this is like especially wallets. Like they were the first consumer product which kind of gave trust to customers, that customers can hold money outside bank, which was never the case in India. They could trust a tech company to hold money for them.
Right.
That was like a really big thing. So I jumped the ship. I decided that, okay, this is probably a place where I want to build my next inning. So in sometime in 15, I jumped a ship to a company called Walnut, that's why I actually came to Pune. And Walnut was set up ahead of me by Amit and Patan, and it was a like money manager app, helping people track money. We had a good traction. When they decided to build this like a fintech, I joined as a third partner, and my contribution was primarily to build the monetization angle, which is like how can we make money, because Walnut was free. So we built out credit score. We tried everything, by the way. We tried insurance, we tried mutual fund, but nothing worked better than credit. And this is around 2000, 16, and we also discovered that most of the while lending had started in fintechs, as well as banks were claiming that they want to do digital lending, but most of the stitching was not done. So UPI was not there; it was just nascent. Also, many other APIs which we take it for granted weren't there. So earlier, So we decided to build our own score, and we said, fine, we'll give you a credit line. Since there was no UPI big time, we didn't think of linking with a merchant. We thought we'll give you money in the account. So we scaled up to a lending product, and then we got acquired by Capital Float.
Right.
This was like we were in the dilemma that should we remain as a tech company or we become a finance company. And Capital Float were an SME finance company. They were looking for a consumer play, so it kind of fit in well.
Right.
So we went there.
We'd spoken to the Capital Float team as well, actually.
Yeah, nowadays, like their biggest product BNPL, which is what their biggest product is right now, is like what Walnut built earlier.
Wow.
And it was essentially, so we had a product called Walnut Prime, which ran on Walnut, and that was the product which was taken there. And now, of course, they built many more capabilities there to enable BNPL across merchants. So I left as post acquisition, and I had a good insight, is that while consumer credit is a pretty obvious opportunity, and given that how young population is there in India with huge aspirations, and affordability is here, aspirations are here, so there's a gap to fund. And a lot of societal changes have happened where people are more focused toward consumption rather than asset creation. So I'm like, this opportunity is not a push based opportunity, it is a real opportunity out there.
Right.
And overall, the third part of the angle is that merchants have made this product more mass. It
Right.
is not an affluent product anymore. It's a hardcore mass product. So I think this combination was quite obvious, for everyone. But idea is that I have wanted to decide that what's the right product vehicle to enter in this market. Now, my previous product for a line of credit, we worked beautifully well, completely digital, no documents, everything was digital. Now today it's easier, but 2017 it was a big innovation. But I came up with one insight that people take loans for very specific needs, and usually they are time sensitive ones. So whatever be the user experience, if they don't remember you in their loan moment, you still have to incur the CAC.
Right.
So because you want money in next 48 hours, you will go and like search for a loan. And and loans are very easy to compare. Interest rate is the topmost, followed by turnaround time, third is amount. So so it was very difficult for us to build our case where you can bring down the CAC so that customers keep coming back to you. There was other model which was like you work with merchants to be available where the consumer wants to consume the credit. The problem with that is that if you're part of the merchant flow, the merchant expect you to certain acceptance rate.
Right.
So you got to you're going to balance out your CAC versus loss equation. In fact, if I take the example of Bajaj Finance, one of the most successful consumer finance company, while we all hate receiving calls from Bajaj, but that's actually one of the biggest value driver for them, because they're able to monetize the base. And if you look at their quarterly deck, they proudly present that these many customers are pre-approved by them.
Right.
So that frequency is what makes that model more.
The reminder, the constant top
Yeah,
of
because it's very difficult to make money on a low amount credit like 20,000-30,000, whatever be the tech you put, because the costs are upfronted. Okay.
Right.
And also Bajaj, cleverly cracked the model of sourcing customers from physical stores, where actually most of the stores actually feel them as a privilege, that because of that credit they're able to sell more.
Right.
So we thought that probably as a tech company, and banks have a clear advantage because they have savings account as a running relationship. By the way, even for the personal loan business they do, where they source customers from third-party channels like DSAs, it's very difficult to make money because your channel cost is too high. But a large part of personal loan business done by banks is cross-sell or top-ups of their old customers. So cross-sell coming from savings account customers, and top-ups means they have a base. Somebody, they gave them a 5 lakh rupee loan. He's already paid 4 lakh, and you give up another top-up. So that's a big source of disbursement for banks. So that brings down your average cost of sourcing, which kind of gets defrayed from your cost of processing cost, processing fee the banks charge. So like, what is it for us to build that relationship? And so we said we should, as a tech company, should build something which is more tech oriented, which can give us sustainable advantage, to acquire and retain customers, because that's when you start making money, or rather make it a sustainable business. So we thought credit card probably is a better product vehicle, because credit card is a recurring product. If you're able to crack relationship with the customer, then they stay with you long. And it's a very high touch product. So the role of technology or other customer experience becomes more important, and that's an area where fintechs have a better chance to win against banks, because it is right in their domain, because most of the banks don't build tech. I'll tell you one more insight. So if you look at the Indian banks tech stack, uh, so there are two most important tech stack, which is why I'm saying important, means they're very transaction intensive. They get used many times. One is core banking, second is credit cards. Okay. And by the way, core banking mostly services not only for savings account, current account, transaction banking. Most of those heavy transaction use cases are done in core banking. Indian banks core banking is fairly advanced. The reason is it's all built by Indian tech companies.
Right.
So, and they keep getting updated every like 3 years, 4 years, because all the new versions gets used by them. Incidentally, in that business, Indian companies rule the world. So Infosys has a product called Finacle, TCS has a Banks 2000, iFlex, which is called Oracle Financial Services now, OFSS has a product called FlexCube. So they're very well advanced compared to the global world.
Hmm.
When it comes to credit cards, it's still dominated by three companies: First Data, uh, T Systems, and Atos. In fact, over last 3 years, both First Data and T Systems have become even large company post acquisitions. Both of them were acquired by larger companies. So T Systems got acquired by Global Payments in like 23, $24 billion acquisition, and First Data got acquired by Pfizer. So no dev teams in India. Everything is built outside India. And of course, I had an advantage of working as an operator in this area. ICICI initially used to be a First Data customer, and then they moved to
Sold
T
the business to First Data.
And then we also moved our credit card system from First Data to T Systems. So I had an opportunity to work with both the partners very closely. So I had felt that from like any change there goes for a longer dev cycles, and all that. So one is, of course, there's an intent, whether we banks want to solve it or not. But even if they have an intent, it is difficult to change. And the last thing is, the credit card is very, like, it's not a single tech stack. Like, you have fraud scoring, you have rewards, you have EMIs, you have offers, you have credit scoring. It's not a file based process. This is a scoring based product. These many systems, I'm like, typical bank will have almost 20 plus systems to operate a credit card business, just for information, right? From customer service. And that's why like when Paytm or a PhonePe does a cashback, they do it in real time. But when banks do it, they don't do it, because it's just not possible to engage, in a bank, to like work with a processing system, to intelligence system, to customer communication system, to talk to each other, because they're all built by different partners, different vendors, on different tech stack altogether, by the way. And things like that. So anyway, so I think we saw that it's a good problem to solve for a tech company. It's a very, very domain heavy problem, because you have Visa, MasterCard, RuPay here. You just cannot issue a card. Even if you build a tech stack, you have to get it certified. You have to do tons of security certifications. Other complication is only banks are allowed to issue credit cards as per regulations. So you have to work with bank. So in a way, it gave us a huge set vine. So on the consumer side, there was a large opportunity. On the build out side, there was a large opportunity, which was not easy for everyone to build. So we thought we can work at our pace. This is something makes sense for us. So that's how we zeroed down on that. So yeah.
Oh, fascinating. There's so much insight in what you shared. Like, I could listen to you for a long time just talking about finance. I mean, the breadth and the depth given your experience. I think I learned a lot. Like, for example, for me, the analogy about how the banking system has been built in India with the tech via Infosys and Wipro and the others. That made a lot of sense, but I didn't really know it. So things like that were quite fascinating. And my question is related to that itself. So you spent so much time in the industry. I don't know if it's rare or if it's recurrent for someone to become an entrepreneur, because you must have spent more than a decade. What was the trigger? So when we speak to younger founders, they're like, I wanted to start up. Clearly, everyone wants to start up, but you took you had a long career at ICICI and could have had a longer career there as well, I'm sure. So what was the trigger for you?
So I would say, like two things, Aviral, and thanks for asking me this question. Uh, because a lot of in the recent times we've seen a lot of people from corporate world joining entrepreneurship bandwagon. As I said, so probably entrepreneurship thoughts were there, but like ICICI operated like a fairly like entrepreneurship oriented bank in the early 2000s. So we was just growing crazy. Like if I tell you that we grew almost at 100% month annualized growth rate in 2002-6, it is unimaginable, but we did that. And so somewhere around 2012-13, like the bank had become quite large. So it had become a much more stable bank. But I think the trigger came primarily because I could see that like this is an area which is going to be the most important part of the um, consumer banking, where tech interfaces will rule the world. And when I say rule the world, will be, I mentioned before also, you just can't build it one time. You have to build it iteratively. So like even if I get a eureka moment now and build this, and by the way, I'm I'm taking the liberty of saying ICICI is reasonably, I would say, better technology oriented bank in the market. Market perceives that, and reality also it is that it's one of the most like bold bank in terms of taking technology calls. But still you build with partners outside, you don't build it in house. So that was a big motivation for us to do. The second thing is, uh, in a way we were also, I'm like, if you look at my team also, most of us, at least the senior leadership, come from ex-banking background. We were also reasonably, I would say, frustrated with what we wanted to do, what we couldn't do, not because our bank stopped us, because there was just not so anybody to solve that. And most of the tech orientation, fintechs were solving for, I would say, thin layer on top of it. Now if you have to build something like deeply in credit, one has to understand scoring, frauds, like just to give you a sense of what I mean. Typically if you took a look at a stack like credit cards, you will break it up into four parts. The base layer is what we call is processing stack, which is about, this is the stack which connects to Visa, MasterCard, does authorizations, movement of money and all that. I would say complex to build, but still commodity. I'm like, somebody who has an understanding of good Visa, MasterCard system can build. It's just a piece, you got to spend some time on it, and you have to go through the certification process. The next layer is what we call is the compliance and operations layer, which is where the reporting happens. Because if you are running a system like credit card, you got to like manage treasury, you got to manage NPAs, you got to manage bureau reportings. All of that is the second layer, slightly more complex than the first one, because that's like a pure tech layer. This is more, I would say, domain specific layer. On top of it, then you have risk. Now typically credit card is a continuous risk product, unlike loans, where what we call is it's a file based approach. If Aviral is applying for a loan, one will go through all the documents that time and take a decisions digitally or physically. And once then money leaves the table, then it's about, if you default, then the collection kicks in. But credit cards are not like that. On every day, every transaction is a risk transaction. So you have fraud scoring, you have line management, over limits, pricing, everything is very dynamic. A lot of people, like, by the way, default in credit card and then they come back. We call it pre-delinquency management. So all of that becomes a very, very, I would say, real-time layer. And then top of this is consumer features, which is what consumer care for, by the way. Everything else is below the hood. So they look for, let's say, offers, rewards, EMIs, like customer service and all that. If I repay a card, how quickly can you process it? All of that is the consumer features. So I'm just saying it's a very layered stack. So, what we said, that a lot of people are building one layer of it. Like a lot of people have built the consumer features layer, by the way. If you look at the UPI stack, most of the heavy lifting is done by the banks and NPCI, and then the phone pays of the world have built on top of it. Of course, now they have built much more deeper stack, but a lot of other companies have just built a layer on top of it, or somebody's built underwriting layer. We wanted to build our, we realized that if you have to dramatically change the cost of processing transactions, or rather bring down the human element in the in a operationally intensive business like credit card, you have to build full stack. So this is something which is very close to our heart, that we wanted to build something full stack. Now, problem in full stack is, if you want to build in a bank, you depend on multiple partners, multiple vendors. It just doesn't happen. So our biggest motivation was that, one is, of course, we saw the opportunity. The second thing is also that, okay, we wanted to do something which we couldn't do sitting in the bank. So these were the two big motivation which drove us to launch. Even after, I worked for bank in 13 years. My other two co-founders also worked for more than 15 years at the bank. Because we all started together as management trainee. So that's primarily. I'm like, rest is all outcome, I guess. Like, we could build a large customer base and all. As I said, in a credit starved country like India, demand is, touchwood, quite solid. I'm like, you don't have to do hard work to get access to demand. The trick is that how well you can process the demand, at what costs, how are you financing it, and how do you collecting it, and still maintaining the customer experience which you want to offer, because ultimately that's what consumer care for. Everything else is part of a business model.
Well, thanks a lot for that. And it's perfect time to segue into our topic for this episode, which is, reimagining credit cards. And you spoke to us about how this was a big problem that you identified. And you also found this unique problem that, banks couldn't solve because their tech stacks were so they weren't talking to each other. And it was a very deliberate decision, to go with this product vehicle of a metal card. Can you kind of help us connect the dots there, and why specifically a metal card? Was it because it was aspirational, and how did that get together?
So I spoke about loans being specific needs. The bad news about credit card is nobody needs credit card. Nobody gets up in the morning and say, I want to apply for a credit card.
Yes.
Good news is everybody can be sold a credit card. So it's a classic FMCG product from banking. And that's why, consumer experience plays a major role there. You typically, reacts to offers, you see an ad, somebody tells you, and you react to it. Other good news about credit card is it's a very engaging product. On an average, an active customer does around 7-8 transactions. You add repayments and all that. So more than 10-15 touch points in a month. It's a very, very active product. So, our thought process was that, okay, so before I come to how are we reimagining, let me speak for like 30 seconds about the consumer side of it. And I would like to call out merchant community, or making it more, mainstream product. See, credit card used to be an elite product 5 years back. It was like, even cities like Mumbai, Bangalore, there'll be few pockets within the city where people will use card and get issued cards. But thanks to merchants, and which got started in, post demand, became more mainstream during COVID times. It's a mass product now. Just to give you a data insights, Indian banks issued around 2 million cards last month in April, as per RBI data. Now, you probably take 500,000 out for multi-carding, which is the same customer got issued the second card. 1.5 million new customers got card. At an approval rate of around 30%, roughly around 4.5-5 million people would have applied. Mind you, this is credit approval rate. The sales application will be even higher. So we are talking about 6 to 7 million people applied for a credit card. And, nothing has changed on the product side. dramatically in last 3-4 years.
So people are applying, but banks are just accepting less people.
This is because the demand has become real. I'm like, and you just analyze this is around like, we are talking about like 60 million people applying for a credit card. By the way, I'm like, just to tell you, like, we estimate there are not more than 110 million people in India who can be given credit card from a credit point of view based on existing credit policy. And then you're talking about a 50 million people applying for credit card. That is the reality right now. And this is, I'm talking about banks. I'm not even talking about fintechs. Okay. This is, by the way, I'm just telling you bank numbers.
Demand for banks itself is so big.
Yeah. So so I think that this is, so demand is all, and this is where merchants have to be commended because they made this product mainstream. Okay.
Yeah.
Now, so for us, we say fine. So demand, I'm like today we can claim, but we saw this early in our life. So we estimate, as I said, around 110 million people in India who can be given credit, and you can get to this number from various means. They're available in our data, but we estimate this number to come from primarily from bureau populations. 400 million people in India have a bureau score. Like we did our analysis of cutting out good profiles, living in top 60, 70 cities, mobile aware. These are three important ingredients for our business model. You get to around 110 people.
Living in an urban population, mobile aware, and what was the third one?
So bureau population, geographical concentration, because there's still 50, 60 cities where payment is more. This is, by the way, rapidly growing as we scale, because, Zomatos of the world are going in like 100 plus cities. Uber is there, Ola is there. So all of they are basically taking our products to these markets.
You just follow them.
Yeah. So we are like a infrastructure layer below them. They are the one who, I'm like, see, credit card, the problem is it is not an end product. It's an intermediary product. The end product is merchants. I mean, you don't take credit card to keep in your wallet. You take it because you want to use it at Zomato or Uber or Ola, Flipkart. So that's why this merchant is very, very important layer for us to drive adoption for this product. Anyway, coming back to reimagining. So the problem was, the first problem was at the time of issuance itself. Now, as I said, nobody applies for it, gets up in the morning and applies. So the point is that you go to aggregator websites, you get some 100 products to choose from. You go to bank websites, you got almost 40 products to choose from. Why do these products exist? Because they build propositions differently, and they link those propositions to 16-digit card number. That's where they have to launch so many variants. Yeah. This is all, by the way, coming from US when Caperman started this in late 90s. We believed a better way to personalize things to you is 10-digit mobile number. So we do issue card, but that's just for payments. We have a single variant, everything else in the app itself. Okay. So keep the decision variables low for the customers. Don't let it, because what happens, it's very easy for you to compare loans, like which is the cheapest. How do you compare a credit card which has a reward points on dining versus one's a reward point on fly?
It's impossible.
Because you want to fly, you want to have both. Why do you need to choose these two? Okay. So that creates, let's say you get through this and you do apply. And no, while most of the banks have digital processes, you still get a call to come and somebody has to fill up an application form and all that, which is where now need-based product becomes. If you have a need-based product, like I'll give an analogy of life insurance. The penetration less than 2%, all of us should have life insurance, but we don't believe we will die tomorrow. So how does it get sold? Somebody catch hold of you. Probably somebody comes to your tech, and most of Indians buy insurance for tax purposes. This is how. So I think credit card had become, rather is right now, a push-based product. Somebody catches you and say, well, apply for a credit card. So we wanted to change that. So we said, fine. The first thing we said was, why can't we build a very, very simple onboarding process? And for simple onboarding process, you got to work with banks so that you can redefine their credit evaluation process. Because first of all, sorry, I forgot to mention. So 3 tenets of our model. One, we work only with banks. So we are like a regular credit card issuer. We don't work with non-banks as of now. Second thing is, we're a full stack company. We build our own tech stack, process everything. And third thing is, as I said, over 110 million people, we thought a large number of there already in the bureau. So we started our product journey from a product called OneScore. Now, OneScore is a scoring app, help people track the score and builds, improves.
It's a consumer-facing credit scoring app.
Yes. Yeah, that was the first product we launched because we saw that that's the population of customers we want to issue credit to. Now,
people who are conscious of the credit, who are actually responsible.
so
I like.
this gives three advantages. One, a large customer base to whom we can sell cards to. Second, we can build a lot of models on this data, because in this business, data is the biggest ingredient, because it's unsecured credit risk. And a second thing is, incumbent have an advantage because they've been doing this business. Last but not the least, while we estimate 110 million people in this country who should be given credit, only 30 million of them have a credit card. So a lot of these customers will have credit card for the first time in their life. Now, credit card is a very flexible credit, because you can pay whatever you want to pay and revolve, but it can also be very dangerous if you don't know how to manage credit well, because it's a high interest credit.
Yeah.
So we thought it's our duty to help people understand how to manage credit. Now, that's a very big topic. Probably when we meet separately, I'll talk about, because we are very passionate about solving financial education, credit education, and how it.
But like, quick question for you about that, because it's a bit of a conflict of interest, right? I mean, you want people to take on more credit. That's better for you.
Interesting. You know what? So let me throw some stats for you. On an average, an Indian today carries their credit card for more than 7 to 8 years. Okay. Now, the only product comparable of the same duration would be mortgage. Okay. This is the too long. So I'm telling you, the trick is to crack engagement rather than maximize in 1 year. If you maximize, if you stay long, and another piece to tell you, like, majorly customer base, our customer starts in the age group of between 24, 25, 26, 27. Okay. That's the entry, age for customers in this product, not only for us, even for banks, by the way.
Yeah.
Now, over 10 years, this person is going to see around 14 to 15% CAGR in income growth. They will see a dramatic change in their lifestyle. They're staying with friends, they live alone, they get married, they have kids. So it's a massive opportunity. Why would you like to maximize it in year one if you crack the relationship with it? So I think the best of the credit card guys, of course, know this equation. So, but I think our thought process is very simple. If you, if you crack, just look at, like, I'm like an Amex. I'm like, somebody's running a card with somebody. They would have given a card to somebody at 25-year-old, probably given them, like, say, I don't know, 50,000 rupee credit limit. At the age of 45, the guy would be having a limit of, let's say, 15 lakhs, 20 lakhs. He might be spending 5 lakhs on it. It is just pure money, pure annuity income. So you got to stay long in this business. You just cannot think short. If you think short, this is not a business for you. Because, like, what happens? Let's take the case of personal loans. That's also unsecured business, by the way. You give a loan, 90% of your P&L is fixed the moment you've given the loan. The only number you don't know is whether he will default or not.
Yes. Yep.
Even the foreclosure fees are also baked in the business model. So then nothing is left. Okay. That's not the case in credit cards. It is, I'm like, first of all, even if the customer is bad, you will not get to know for next 4 months, because he's going to get the card, use it, see it couple of months, and then it is by design and long term. So like, one of the first advice people I tell is that first think super long term. Nothing happens in this business in short term. Well, even if I take a decision today, I will see the impact of that only after 6 months. But was I wrong? Was I not wrong? Or was I right? So you got to build that long-term thinking. Only then, I'm like, the profitability in this business globally is very high, is because of long-term outcome of this business. Because
you're user base
same
and
customers,
monetize.
you keep making money from the same customers over a period. It's, in fact, one of the investors was telling me it's a classic SaaS business. I said, we never think it like that, because it's a recurring revenue business. It's a hardcore recurring revenue business. If you crack engagement, like, just imagine in India, not in India, across, a lot of people have very strong affinity to their first card. Even if the credit limit is small, they will still keep it in the wallet.
It's true. It's true. It's just your first card. It has some meanings, especially.
I'm like, somebody would have given you, let's say, 20,000 rupee limit in your college.
Yeah.
You will always keep it in a wallet, whether that product has any, and you might use it occasionally, some bill payment or something. So this is the thinking you have to have in this. So I'm like, for us, anyway, I think we jumped the gun. What I was trying to say, we basically identified two sets of problem when we were reimagining. One, we got to solve for onboarding, and for that we need to work a lot with our banking partners to automate the entire underwriting process. because unless you automate the underwriting process, you cannot offer credit card online in real time. The second piece was, which came handy thanks to RBI. A lot of online KYC options were available, so we relied on them. And the third piece of the puzzle was building our own issuance stack, which can issue card on real time. And this, we're talking about credit card, not talking about prepaid cards. We're talking about credit cards. And I say credit card, stacks are like complicated by people like Vision Plus and all. They haven't built a completely mobile first user experience. So
Just
in a way, we got
that's when you say credit stack, right? That's also credit scoring and assigning credit to somebody all in real time. Like you apply.
That's the first thing I spoke about, which is the underwriting process. But the last point I said was just issuing a credit card online in a mobile app.
So you get a virtual card that you can then use.
So in 2019-20, when we built this was innovation. Of course, a lot of people have then after that adopted it. So that was first part. But the second part was basically about existing customers. Like most of the customers, their prime experience post issuance is call centers. Now, I'm not even getting into mobile apps, like how badly or good they're designed by banks. I'll tell you another insight there. Most of the banking apps, and talking about the all leading banks in India, the prime real estate is given to savings account business, CASA businesses.
Yeah.
Because the most of the banks app businesses are part of those verticals, and their prime objective is to remove customers from branches to apps to reduce costs. The other insight about credit card businesses, almost 60% of the customers do not have bank account from the same bank where they have had the credit cards. And the simple reason is because 4 banks dominate credit card business in India. 4 to 5 banks have almost 85% market share. Vis-a-vis the same banks controlling less than 40% in CASA business.
Yeah.
So, so those customers, even this interface is not there because the entry to the app is from savings account. Got it? So the front-end tech was completely absent. So the prime engagement model for banks is call center. The call center was an innovation in 90s because the second best option was to go to the branch. Today it's a nuisance. So I think we thought, an app-based experience will make sense because it's a highly engaging product, and we were right. On an average, our customer does around 7-8 transactions in a month, but he visits our app more than 20 times in a month. I'm like, and I'll tell you one of the insight there. What do they do? Most of the Indians believe that when they use credit card, they overspend. That's a thought process in everybody's mind. But when they get to see their transactions in real time,
different in the West, where credit card is kind of a default form of payment, right? Like
yes,
for excess.
Yes. See, we still have hangups about credit in our mind.
Yeah.
Us parents will be like, credit is the new. I'm like, and by the way,
credit is bad.
Nobody takes credit card assuming it's a credit product. Everybody thinks that they're going to take credit card, they're going to pay on time and make some rewards.
Yeah.
Because otherwise, why would you borrow at 40%?
Exactly.
It just
doesn't make sense.
So it doesn't make sense. So, but there is a back of the mind, it's a credit product. You have a line of credit, and you should live well within your means. But like this insight I carried from my, of course, Walnut days. You basically show back your data back to customers. You feel better in control. You will transfer all your spends on this instrument where you can track it.
So it comes down to expense tracking.
So, exactly. The second, I can go long on this, but I'll give you one more insight and then I'll shut up. Most of the people, and that's not true for India, even for abroad, would like to repay their limits, their credit card outstanding on the due date, because somehow it's built in your mind.
Yeah.
Now, unlike loan repayments, credit card repayments are slightly more complex. Because loan repayments and EMI, fixed EMI, everybody knows this principle is an interest and all that. Credit card EMI, credit card bills are dynamic. I mean, you could have used something yesterday, you might have done some EMI and all that.
Yeah, exactly.
So you pay on due date, then you worry whether this will get processed on immediately or not, because then you don't want to pay late payment fees. People have very strong views against late payment fees. So in our case, since we built a full stack, an app, you pay in our app, you get processed in 30 seconds. You can see right now in your app. So sure. I think what I'm trying to say is that we don't believe in building one hero feature. Like 20% off on this merchants. It's not that it's not important, it's important, but we believe that solving the underlying user experience on different types, like we don't send OTPs for second factor authentication. You can convert on an EMI in app, you don't have to call us. So all of that creates like a hook for customers, and which is very silent hook. It's difficult to explain. And
Yeah,
okay, so
it's engagement, right? It's
which
wanting
brings
to
me
use
to
your
the
product. Yeah,
which brings me to the final answer.
yeah.
So our product has to be experienced before I can tell you. I can't tell you in an ad that my app is better than others' app, which is where Metal created that kind of trial. Metal creates a trial for you to come to and experience the app. Okay.
So the
Okay.
card is sort of the lead gen that
Yeah. So,
that you're going to get this experience. Yeah.
so frankly speaking, when we launched our wait list, we thought for 10,000 customers will do Metal, but somehow it just got stuck to us, and like now it's part of our brand
The
identity.
metal card.
Yeah. So Metal, but there is another brand angle to it, that like our product, Metal gives you a premium positioning, but like, and that allows you to position. So in credit businesses, you have to position your brand above a segment where you want to operate.
I was going to ask. Okay.
That's a
So you want to
nuance.
appeal to everybody, but it's like the Van Heusen of the worlds and those kind of
So
brands.
that's a nuance in credit business, because what happens is that in credit business, if you don't get access to your demand, then what happens? Eventually, your credit model will catch up with the lower. So it's like when you get lower end customers, you build
Yeah,
lower end
kind of
credit.
a spiral,
You
right?
so
Exactly. Yeah.
yeah, and I've seen this in first hand in banks. Despite 40-50 variants, 80% sale happens on only 2 or 3 variants, because that is what sales want to sell. We wanted to solve it through marketing, and which is where positioning a brand, a premium brand above the segment where you want to be. We are not a premium brand which like has lots of high end features. We don't
Yeah.
come. We are a mass affluent to mass brand. Okay, but the brand positioning is a notch above to allow us to position there.
Which I mean itself is an incredible insight. And I mean, obviously you've kind of seen that play out. You guys have seen tremendous growth over the past couple of years. You're kind of proving your model. How has stuff evolved? Like, so you talk about the role of regulation, but how do you work more actively with regulators now? How has that sort of changed as you've grown? And what role is
So
regulation playing?
So I think like one advice I give a lot of fintech founders, that you have to embrace regulations. The good news is RBI is a very progressive regulator. Like they keep evolving, and good thing to note is that in January this year they've created a fintech department. And creating a department in regulator means that these set of people will be working to grow the, I would
Dedicated.
say, yeah, the health of these set of entities, because today fintechs are not defined by RBI. Anybody can be a fintech. And I think the one of the first framework, we're all expecting them to define us in what category. Because so right now our regulations are as from banks, because we are not regulated by RBI directly. We're indirectly regulated by RBI via banks. So we operate under bank. But just wanted to on the credit side, this is a new evolving area. But in other areas, RBI has already done a lot of good work. So, if you recall, in savings account side, way back in 2012-13, the BC regulations came, which kind of drove the expansion of savings account to the country. I'm like, today we take a billion savings account for granted. Just 8 years back, it was hardly 400 million. So, and this is primarily done through PMJDY and tons of, BCs who created this ecosystem. Then came payment revolution, which was led by UPI. And today we take pride of the UPI, but a large number of consumer adoption is done by tech companies like PhonePe, Google Pay. Again, the framework was created where there was a mix of banks and tech companies work together, on an NPCI-led framework, which are also, I think we're all expecting credit is the next way to go. The working group paper came in November. We're waiting for the final regulations to come in. So, regulations play a major role, especially in the last, I would say, a year and a half, 2 years. That the pace at which this regulation is changing, especially affecting the digital side of the banking, is very much. In fact, almost every monetary policy statement, governor speaks about digital banking, and he gives some, insight about this is what RBI is thinking. We want to come and regulate this area. So I think, in India, RBI has always been a fairly hands-on regulator. So we will be expecting a lot of regulations to come in. So one has to be ready for that. I just want to add one message here, which, and it's not my message. A lot of my RBI interaction, people talk about that. Regulators say, when we compare Western regulators and our regulator, in Western regulation world, most of the regulator's job is to regulate.
Yeah.
Okay. But in India, and there is always fight between innovation and regulation, that, like if you
Which
regulate
is
too much
naturally
innovation,
fine.
but like Indian regulations also, regulators have to also look after consumer protection,
Absolutely. Yeah.
because the Indian population is still learning about financial services. And so that's why they say that we have to actually work on 3 problems at a time: innovation, regulations, and customer protection. For example, the second factor auth, I remember in 2008 when it came in and I was part of the committees, we were all opposed it. And like you say that, just imagine how many cases will go to the court, how many cases will go to the police station, and we have no infrastructure to manage it. So
No,
you got to
it's so
build.
easy to criticize your regulators, right? And say, oh,
Yeah.
this is stifling innovation, but I mean, it's so much more.
So, you got to find a balance between innovation, regulation, and customer protection. So this is what it is. So like, I just want to send the message to everyone that embrace it. And the good thing is, if you look 3-4 years back, most of the fintech activity was around solving cost related issues. Okay. Now more banks and regulators both believe that fintechs can actually drive adoption. And that's a big change in thought process. And that's why more revenue based arrangements are being done, more like co-creation is happening, and things like that. So I'm like, we are heading towards that world, and this is it. This is what it is. The only thing is, we at some level when you reach a certain critical size, I'm like, whether we like it or not, regulation will come, and we have to be ready for that. And that's probably the right way to grow this sector, in an orderly fashion. I'm choosing my words very carefully, and that's probably is needed, because we all believe that the penetration is too low. We are not competing with each other. We're just solving the adoption problem, and so there is a huge space for all of us.
And then curious, I mean, since you brought that up, I feel like I have to ask, you say you're not competing with each other, but there are a lot of fintechs in the space. A lot of people are tackling similar areas. What would you say is your USP, and what makes you different?
Awesome. Before I answer this straight, let me give you a slightly market perspective. So as I mentioned, we believe there are around 110 million Indians who are eligible for a credit card.
Yep.
And that number is growing at a rate of around 10 to 15 million a year. That's a new number of borrowers being added in India. Also, uncannily, this number is very close to the organized job creation in India. So, that's a number quite stable.
People get jobs, they can afford credit cards.
Because unsecured credit is typically linked to salary growth, job growth, very, very closely. Now, we have today 35 million people holding credit cards, 70 million cards. So it's around 2 ratio. If I just assume that ratio to continue, it'll actually grow more, because in the last 5 years, it was hardly 1.2, today it's 2. So we're talking about around 230, 250 million cards. Existing banks will go from 70 million to 150 million is what because they have large customer base of their own. The rest 50-70 million will come from people like us. Okay. Now, credit is not a winner take all market. Just to tell you, if you're having a 10 million cards, okay, you got to manage $6 to $7 billion worth outstanding. This is complex. Okay. Bajaj Finance has an overall lending market share is 3%. That's it. This is how diversified lending industry is. So it's unlike payments, which is a winner take all market. I'm like, like if you talk about UPI, probably people will remember about the third app, which is the Paytm. After that, nobody remembers about any other app. Credit is not going to be like that, because it is a complicated product. Now, that's the first side of this. The second part of this is that because there is an adoption happening, consumer will get access to more and more cards. And I'm really bullish on account aggregator framework, by the way, because that will enable more. I'm like, in our business, most of the underwriting based on bank statement cash flows. So this will simplify this. So what I'm trying to say is that getting cards will become easier and easier and easier. The real battle would be on wallet share, which is the product which you will pull out and actually use it, which is where experience will make a lot of difference. Right now, it's primarily land grabs, but it'll go. Now, coming to competition, though I don't typically give views on state competition, but let me give you some color to it. Like the way I see that there is a scope for others. Like if I talk about some of my immediate compared competition, what markets believe so. even though they're not credit card, they're like credit cards. So like our product today, the new to credit segment is hardly 10%. 90% of our customers come from customer base who already have borrowed before, not necessarily holding credit card, by the way. And the reason is because we work strictly with banks. Now banks have a different way of looking at risk, so naturally their risk approval criteria are like banks, and they typically prefer profiles with prior credit experience. The second thing is, as I said, there is a large base of customers available who have already borrowed before, who have served a history, so why not monetize that? Vis-a-vis a lot of my other fintech friends are trying to solve credit access problem, which is customers who don't get access to credit or who have never accessed credit. They're almost 60-65% of their potential numbers come from there. Now, similarly, that reflects into the kind of credit we underwrite. Like our average credit limits are 100,000 rupees, because that's the limit which typically where banks underwrite, while lots of other my friends underwrite at much lower limits because they are solving credit access problem. So I would say when I say this 200 million possible credit card penetration, all of us will find our way. So we are actually not competing because models are very different. We borrow from banks, our cost of funds are quite low, our credit criteria is much more tighter. I'm like, there are customers, we also give cards to people who are new to credit and people who have bad credit, but we actually launched a secured card for them. You can put a fixed deposit and take a credit card against that. We have issued almost 70 to 80,000 cards on that. People are really loving it. Still early experiments, but our way to solve that credit access was this way, rather than giving a credit product with an NBFC and do that. Okay. So now whether we are right or they're right, it's a very difficult to pass a judgment. But what I'm trying to say that we are catering to different segments, and all that. So a lot of people say, why don't do BNPL product? And I think if you ask me, BNPL is a much better product to sell because it's a need-based product. If you get access to EMI, you can buy the phone, which you couldn't. But it's difficult to build an engagement there. We are an engagement-oriented product. So we also offer EMI, but after we have issued the card. So it is a different approach than that. I think this comes from the belief that credit is a very large market. We don't have to follow anyone. I'm like, touch wood, our customer acquisition cost is quite low. Our activation rates are fairly high because there is a very large opportunity. I just mentioned, I was describing, forget about us. Even existing banks are issuing 2 million cards. I'm like, they have not done large innovation. They probably have launched some new product variants. And we are all riding the wave of consumer adoption, which is started from merchants. That's where I will probably wrap up my answer.
Understand. How are you seeing macro today? We are suddenly entering this almost recessionary phase. Generally, what I've seen is the up cycles go up, and then I think over the last 2 years, because of a lot of liquidity in the market, it's been, I think, unprecedented. But whenever things go down, they're pretty steep. And you've lived through a recession before, which was focused on the financial markets. What's your opinion about the next 2 years? How does that change things for you? Or does it? What happens to lending and other related products?
So one is credit is a very cyclical business. Consumer credit is even more cyclical because consumer credit is dependent on two big variants. One is income, job creations, because so that you have an affordability to repay a credit, and second is consumption, because if you have consumption needs, only then you will consume credit. So
Right.
These two variables are, and if you notice, these are very cyclical variables. Okay.
Right.
The good news is these two variables are essentially get captured in things like GDP per capita and all, and they get tracked like crazy. So
Right.
we have very good data available statistically, which is a rarity in India, where one can see and make decisions on. Okay. So macro is super important for us. So one thing I said, whether I'm like recession or something else, it's a cyclical business. It's a 3 to 4 years every time a cycle comes. This is my 4th or 5th cycle I'm seeing in my lending career. Now, here is my reading about the situation. One, Indian macro looks super good right now. the balance sheets of Indian lenders is one of the cleanest I have seen in last probably 15 years. Well capitalized, a lot of losses have been taken. So, like during those COVID periods, I mean, it was already stressed before, right? Even before COVID started, as you know, GDP growth was tapering off,
Right.
and NPAs were started. So so it just got aggravated. So this is on the credit side, fairly strong balance sheets right now. Liquidity wise, also a lot of money. So during crisis, every time we have seen a crisis happens in, most of the Indians put money in safe places, which is where banks, take all the money. So that's why even 2021 and, like 20 and 21, both almost $100 billion extra deposits went into the banks. And so that much is not lent. In fact, if you look at most of the analysts chasing bank CEOs that why, your deposit growth is happening, when will you restart your asset growth? Our response towards COVID from government side was also quite measured. We didn't do any of the salary support program. Government mostly supported food rations, and they supported this SME growth, the ECLC scheme, where they provided loss guarantee covers to banks. So that way, we didn't spend too much money. We didn't print too much money. So that kind of is helping us now. Third thing is, genuinely, we were all locked in, so we didn't spend money. So everybody has saved more, and there is a kind of revenge spending happening in every sector we are watching. So credit side and consumer markets, touchwood, things are fine. Job losses have not been any. In fact, like barring the media keeps writing about few job losses, about few startups, but they've, you also have to look at the job creation being done. I'm like, most of the services industry, the traditional companies are hiring big time. Even, like even the lot of tech company, I'm like, like the tech talent war still continues. I'm like, we are not seeing any drop in that. So I think, like few business models which were always edgy, probably have lost, but otherwise job creation, touchwood, is happening decently. So I've covered credit markets and I covered consumer markets. Both the things are completely, intact. The worry is inflation, and inflation is largely coming from oil, as we know, and which is linked to a war, which none of us have any control over it. So, and inflation is a very closely watched number by RBI, and rightly so, because we're a very price sensitive country. But let me tell you two insights about that. Our inflation rate is right now close to 7.5-8%, depending on which economist you believe. But traditionally, we have handled 5%, 6% inflation quite well. So we are just high by 20-25%. So we are well within our limits to handle that. The second thing is, the household debt ratio is quite low. So an average household still have a leeway to absorb this. And we, like extra interest rate. And you're forgetting that we just had a fairly strong income growth in March, April. So, like all the, there's no immediate pressure, but if the inflation remains sticky, it goes for next, let's say 9 months, 12 months, which is where it starts affecting us big time.
Right.
Okay, so that's why RBI is reacting, of course, at the right time to bring down the growth, balance growth between growth and inflation. So that, but for a business like ours, inflation, a bit of inflation is actually good. You know what people do? They'll spend less in terms of quantity, but the value as the spend will still be the same.
Right.
I'll tell you what FMCG guys do. They will reduce the grammage, keep the pricing same.
Right.
Which is what, as a, like consumption credit company, we typically, companies like us don't get affected in that in short to medium term. Beyond 12 months, it will become a sticky factor. The real problem is the equity side, capital markets, because capital markets are super linked across the world. And all the numbers which I'm telling you are super wacky in developed markets. I had never imagined that I will live in a world where US inflation will be higher than Indian inflation.
Right.
And especially you have to see in the context where household debt GDP ratio is very high in US. Income growth is 1 to 2%, not more than that. And in that economy, if you give a 8% growth in inflation, it is going to be a riot. So, which is what they are seeing tough times right now. Now, so we get affected, of course, on the equity side big time because the markets are linked. But if you notice, Indian equity markets are still holding up quite well because the participation of Indians in equity markets have gone up dramatically in last 3-4 years. So like, I was talking to some of my markets friends saying that the only person who used to stop Indian market decline was LIC. Now we have SIPs, which is almost 22,000 crores a month hitting the market. And then you have also the EPFO funds and NPS funds who are now given allocations to put in equity. So we have 3-tier structure to support Indian market. So probably the growth mojo will only come back when the markets globally, come back. But at least I would say, the market will not. So this impacts. So good thing is most of the Indian banks and the large credit books have already well capitalized with a good capital adequacy ratio between 17-18% to some people as high as 20% plus. So they have a huge headroom to grow, at least for next, I would say 18 months to 24 months. And we're all hoping that we will find solutions in next 12 to 18 months about this. So I'm quite bullish on the current macro. We just have to ride through it. Now, I know I'm making a very generic comment. There are business models which are going through turmoil. But one has to look at it. Some of these models probably didn't make sense on day zero itself. And some of them were actually designed to solve something which was not done before.
Right.
So naturally the failure rates will be high. I'm like, we can pass a judgment now in hindsight. So I think, but the good thing is that early stage ecosystem is quite strong, funding wise, and all that. I think the real pinch is on the late stage and mid to late stage companies, which is where we are all expected to now focus on unit economics and and all that. So this is what so I don't think lending opportunities will actually grow. If you ask me, this financial year we will have a very, very solid growth. Every banker I speak to them is focused on growing the lending book. So I think this will trickle down for sure.
Understand. Awesome. Amazing conversation. Just our closing question. What's one piece of unfiltered advice you've received in your journey, either in your banking days or as a founder, that changed the way you looked at things? And brutal honest is better.
I'll tell you. So I think when I shifted from like a stable corporate job, into entrepreneurship, that was my biggest turning point in my career. So naturally, both in terms of my my vulnerability in terms of receiving a feedback,
Right.
And also I was coming to the world from the world where most of the mentors or leaders had a large corporate background. So you also take their feedback with a pinch of salt because this is a different world which they have not seen it,
right?
And all that. So one thing, of course, my biggest thing was how do I learn about this? And unfortunately, when I was doing my journey 2014-15, there was hardly any write-up available about Indian startup ecosystem. Most of my learning came from YouTube videos for US products. I'm so happy now. A lot of things have been written about Indian startup ecosystem, Indian product journey, so people can learn from it. So one of the most important feedback was from one of my ex bosses, and he actually was a banker. I mean, he's still a banker, but he worked as a VC for few years. So he had kind of seen closely the startup ecosystem. He gave me one advice, because a lot of people were saying that if this doesn't work out, you come back. I had a good career, 13 years in a bank. Almost everyone in the banking industry. It's a very closely knit industry, by the way. But he gave me a different advice. Anurag, don't carry that in your head that you'll come back.
Right.
You should imagine the wall behind you, because you will not know. You would just keep moving ahead. If this doesn't work out, you do something else. If that doesn't work out, you do something else. So don't think that you have a safety net. I actually didn't call me safety. He said, imagine it's a wall. You just can't come back. There's no safety net. Because safety net concept, I'm like, frankly speaking, one of my other bosses to say that, went to, you did IIT, you did IIM, like this is the most insecurity. I'm like, what else do you want to do? I'm like, you can always come back. So I think don't think from a safety net, but I think we all have safety net. We have friends you can do. But
Right.
more importantly is that think of like a wall, you can't come back here. And he made a point that, a lot of people will connect with you because they never thought that you will do this. Like you stay so long in a bank, everybody just assume that this is what you want to do in your life. A lot of people never approach a topic like that. That okay, fine, and they would like to do things with you. And he said the reason I'm telling you because you're gonna be on your own. I mean, you had a large institution behind you, so of course your relationship will be there, but you still have to work yourself.
Right.
So make sure that you just look ahead. Don't look behind, assuming. So many people told me, if this doesn't work out, you can come back, you do that. And I always carry that thought in my head. And many of the my friends or my juniors who call me and say, I want to do something on their own, I gave them only this thing. The second advice, which was actually advice, it's not advice, it was more of an observation. I left when I was typically at I was doing quite well at the bank.
Right.
This is also people say, okay, you shouldn't get into startup or other entrepreneurship because you are not doing well in your life and you want to explore this.
Right.
Okay, fine. This is, I was not doing it, but somebody made an observation. Again, a very senior mentor I look up to, and he said, okay, he was checking on me that, like, do you want to do because you believe, I'll tell you, and especially one of my mentors, because since I have done card business before, and one of the big advice he gave me that you shouldn't try to build a better credit card business which you ran at ICICI.
Right.
Okay, because it's like you cross grade 10, you went back to 8. Of course, you will get more marks the next time you write grade 10 because you know the questions. You should try to solve what you want to build rather than try to solve what problems you faced in the bank. Those are your learnings. That's it. Just forget about it. So, I think I've been fortunate enough to have some of these mentors who can see through me and gave me advice. And by the way, all three of them did not have, one of them had a VC background. Second one did his own startup for a couple of years, way back in 2006-7.
Right.
And startup wasn't the world. And he actually built a tech product that time, which didn't work, of course. And the third one did not have any, entrepreneur. But all of them accomplished, but like they could give me advice from that side. So I carry these things. So keep looking ahead. Imagine there's a wall behind, so that you don't have to come back. And people relate to safety net. I don't call it safety net because I think we're privileged enough to have safety net. Second advice was don't try to improve things because we carry the baggage. I've run this product, I've run this business. Just try to fix those small things, give you small short-term success but can't sustain. Third is don't do because you're not doing well here and you believe you can crack there. Because that market is very different. And of course, now I can vouch for it, having spent 7 years in this side.
Amazing. Awesome, Anurag. Thank you for your time. Love the conversation. Lots of insights. I got I think a very, very good lesson on finance, fintech, India. Despite having been in the ecosystem for so long, I think I learned a lot.
Awesome, Aviral. It was pleasure talking to you guys, and all the best. Keep doing it.